right, I'll go ahead and get started. Hello, everyone. Thank you for joining us for Nelson Capital's annual fall presentation. The title of our presentation today is Optimism Holds as Labor Market Cools. So far this year, we've seen equity markets have really strong returns driven by AI tailwinds, resilient consumer spending, and supportive monetary policy. However, we are beginning to see risks building beneath the surface. And so we'll dive a little bit deeper into some of these risks in our presentation today. First, I would like to introduce our team here at Nelson Capital. As presenters today, we have our Nelson Capital partners, Brooks Nelson, Steve Philpott, Darcy Nelson-Smoot, Evan Nelson, and I'm Chrissy Dionda. The rest of our team here at Nelson Capital consists of Marissa Wisniewski, Tiffany Young Garcia, Kelly Bojo, Ann Oglesby, and the newest member of our team, who's not yet pictured here, Alexandra Kogler. So we will be hosting a Q&A portion at the end of our presentation. If you have any questions throughout the presentation, please feel free to click the Q&A button in the meeting controls at the bottom of your Zoom webinar screen. We'll work to address as many questions as we can at the end of our presentation. With that, I will get started with the asset class returns. So we've had a rather tumultuous year so far. Earlier this year, we saw equity markets fall nearly 20% after tariff announcements that were worse than expected, but that dip didn't last too long. Markets recovered quickly, and by the end of the third quarter, all major asset classes were positive for both the quarter and on a year-to-date basis. Now, if we're starting at the left side of this chart, international equities have been a standout performer. Emerging markets are up 29% and developed markets are up 26% so far this year. And part of the reason for this is AI optimism, lower interest rates, as well as some rotation out of US assets amidst this rising geopolitical tensions and tariff wars that we're seeing. The technology-heavy NASDAQ index is up 18% year-to-date. This includes an 11% gain in the third quarter alone, as enthusiasm around AI remains really strong. The S&P 500 was up about 8% in the third quarter and 15% on a year-to-date basis. And the leaders here are mostly these large tech companies that are making these really big bets on AI infrastructure, but we've yet to see the payoff from those large investments. Fixed income has posted moderate but steady returns. The Barclays Intermediate Government and Credit Index is up 6% on the year, while the Barclays Municipal Bond Index is up about 2.5%. And finally, small cap stocks had a really strong third quarter after the Federal Reserve has kicked off its easing cycle with a 0.25 percentage point rate cut in its September meeting. That has given smaller, more rate-sensitive companies a 9% boost in the third quarter, but they are up only about 4% for the year. Moving on to the sector performance. 4 sectors have outpaced the S&P 500 year-to-date. We have communication services, information technology, industrials, and utilities. So communication services and technology, they're both up over 20% so far this year, again, driven by that continued optimism and enthusiasm for artificial intelligence and all of the related infrastructure growth associated with it. Industrials are up 18% so far this year. They've benefited from increased infrastructure investment and reshoring trends, bringing manufacturing back onto US soil amidst all of the geopolitical tensions that we've been seeing and supply chain issues that we ran into throughout the pandemic. So we're seeing this particularly across semiconductors and pharmaceuticals. The utilities sector has increased about 18%, supported by a surge in electricity demand. This is tied to the expansion of data centers that are powering this AI development, as well as other AI applications. Now you can see consumer staples is the only sector that is down either on a year-to-date basis or in the third quarter. So that's down like 2.4% in the third quarter, and investors have kind of rotated out of the more defensive areas, seeking higher growth opportunities. This sector has also faced margin pressure from rising input costs, slowing earnings growth. So it makes the sector a little bit less appealing in that risk-on environment. Meanwhile, consumer discretionary was a notable outperformer in the third quarter, alongside communication services and technology. And the reason for consumer discretionary outperforming was resilient consumer spending, easing further rate cut expectations, as well as strong earnings growth from some of the major retailers, automakers, and travel companies. So taking that into account, it's really reflecting optimism about ongoing economic growth at this point. Now I will pass it on to Evan to discuss corporate earnings.
Thank you, Chrissy. As Chrissy touched on, we've seen really strong returns in equity markets this year, and a big part of that can be explained by solid earnings growth. The bar chart on the left shows year-over-year S&P 500 earnings per share growth, broken down by margins and revenue, with margins in gray and revenue in light green. Both this year and last, earnings have grown at double-digit rates. In 2025, margins contributed roughly 6% to earnings growth, and revenue about 4%. Looking ahead, consensus expectations for the next 2 years call for about 13% earnings per share growth. Historically, when we have above average earning growth and it coincides with a Fed easing cycle, equity markets tend to deliver positive returns. Overall, profit margins are currently at 13.6%, a historically high level for the S&P 500. Another major theme in markets this year has been artificial intelligence-related capital expenditures. So this bar chart shows spending from major tech players, Alphabet, Amazon, Meta, Microsoft, and Oracle, climbing from about 211 billion last year to nearly 350 billion this year, and projected to exceed well over 400 billion over the next 2 years. So in total, we're talking about trillions of dollars going into data centers, semiconductor development, and cloud infrastructure. There are some echoes of the dot-com build-out here, but one key difference is that these are mature, profitable companies with robust cash flows and strong balance sheets. As a share of operating cash flow, AI spending is expected to rise to 60% in the coming years, as shown by that blue line. Looking ahead, as Chrissy mentioned, we will need to see some revenue generation to justify these massive investments. So consumer spending has remained a key source of strength for the economy, but the composition of that spending has changed meaningfully. This chart shows that the top 10% of income earners now account for nearly half of all consumer spending, up from about 35% in the 90s. This shift reflects both that consumer bifurcation that followed the pandemic and the long-term trend of wealth concentration. High-income households have benefited the most from rising asset prices, both in equities and real estate, which has supported their spending even as borrowing costs have risen. Basically, when your investment portfolio is up and your home equity are up significantly, you're more likely to spend on travel and dining and discretionary goods. Lower and middle income households have faced more pressure from inflation and high interest rates. Wage growth has slowed, pandemic savings have largely been drawn down, and credit card balances are at record highs. So overall consumer spending remains healthy, but it's being disproportionately driven by higher earners. And the credit market remains calm and continues to provide a constructive backdrop for risk assets. This is credit spreads, which is the difference in yield between US Treasuries and high yield bonds. Right now, it's around 2.6%, which is low by historical standards. This indicates that investors are comfortable taking on credit risk and default expectations remain contained. During periods of economic stress or financial instability, these spreads tend to widen significantly. For example, during the Great Financial Crisis, high yield spreads expanded to roughly 20%, and during the pandemic, they climbed above 10%. By contrast, today's tight spreads suggest a relatively benign credit environment and continue investor confidence in corporate balance sheets. And now I'll turn it over to Darcy Nelson-Smoot, who will discuss some of the risks this bull market is facing.
Great, thanks, Evan. So I think we've covered most of the optimism that we alluded to at the beginning or at the title of this presentation. So now let's look at the risks. I think valuation is really one of the biggest. This chart is showing the price to forward earnings, that's showing that ratio over the last 30 years. And we look at this valuation on a regular basis because it kind of gives you an idea of the answer to the question, are stocks relatively expensive or are they relatively cheap compared to what they're predicted to produce in terms of earnings over the next 12 months? So there are some high points. Of course, the 1999 .com era, we saw valuations of about 25 times forward earnings. And of course, in the wake of the financial crisis, it was as low as about 11 times forward earnings. But you can see we're kind of at a recent peak at 22.8 times forward earnings. The average is about 17. We're above that, one standard deviation over the last 30 years. So even if we're not quite at the .com era level valuations, we're about back to where we were in the peak following the pandemic, which is of course driven by a significant bounce in the stock market after a 30% drop, but also from a decline in earnings. So the decline in that denominator that caused valuations to spike. So, looking at this, I think arguably we are at a concerning valuation level, and that is the primary risk. One of the other risks that we are keeping an eye on and monitoring is the heavy concentration of this stock market. The S&P 500, as many know, is 500 different stocks in a basket. It's a market capitalization weighted index, meaning as the price of a stock increases on a faster relative basis, outperforming the rest of those 500, it becomes a larger and larger part of the index from a percentage basis. So at this point, the top 10 companies in this basket of 500 make up over 40% of the entire index. So this right-hand chart that we're looking at, that's the gray line, and it's over the last 30 years, this is the most concentrated this index has ever been. So is that a concern on its own? Maybe not, particularly if we look at the green line, which is showing the contribution of those 10 companies to the total basket of earnings, and it's quite significant at 32.5% of the total earnings. So it may, it may be that these companies are large in terms of the percentage of the S&P because they contribute a lot of the earnings. Nevertheless, if we look at the left-hand chart here, this is showing the valuation of the S&P in gray, which we just looked at on the last slide. But it breaks out just those top 10 that we're referring to. And if you look at their current valuation of 29.9, that's quite a bit higher than the average level of about 20.6. In fact, it's roughly 1.5 times the average. So even though these companies, are generating significant earnings, they're kind of relatively expensive, especially if we can compare to the rest of the S&P 500 or the remaining companies, which are shown in blue. So we've talked about the valuation as a risk, the concentration as a risk. This is, I think, the biggest economic risk that the markets face, which is the slowing in the labor market. There are lots of different data points to look at in terms of take the temperature of the labor market of the US. We've looked historically at the year-over-year change in non-farm payrolls. Non-farm payrolls is basically another word for the total number of jobs in the US. We look at the rate of change in this number, which is shown in the dark blue line here. Those gray bars are recessions, historically, going back to the mid-1970s. We've noted in the past that when this rate of change dips below 1%, it's common that a recession soon follows, which makes sense, right? Because the labor market slows down, consumers lose some of their ability to keep up their consumption, and that slows GDP, which is 2/3 made up of consumption. So where are we right now? With the latest market data that we have, note that's got a bit of an asterisk to it because with the government shutdown, these data releases will be delayed. But with the data points that we have to date, the rate of year-over-year change in non-farm payrolls is below that 1% threshold. So that could indicate that we might be seeing a slowdown coming. The other complicating factor, even before the shutdown began, was the reliability of this non-farm payroll data. So this is collected by the Bureau of Labor Statistics, the BLS. They survey companies and basically ask them to report how many jobs do they have on their payroll. The survey response data has been declining, and therefore the BLS has had to estimate a larger and larger percentage of those numbers. Now, the Bureau of Labor Statistics puts out the numbers, and then they do a subsequent revision on an annual basis. And those revision values have been getting larger and larger as the data has gotten less and less reliable. So in 2024 and 2025, the negative revisions were really significant. In fact, they were the largest negative revisions since 2009. So this data is important, but it's difficult for even the BLS to estimate. So that's another challenge. And the fact that we've seen 2 really large negative revisions could also indicate that we are seeing that slowdown in the labor market. So with that, I'll pass it off to Brooks, who's going to talk about a few of the other risks, including tariffs.
Thanks, Darcy. Yeah, beginning with tariffs. Tariffs have been in the news since the start of the year. We've had really for the entire period up until the first Trump administration, we've had tariffs at an historical low of about 2.5%. They ticked up a little bit under Trump 1. And then we had this year, the Tariff Liberation Day on April 2nd was a shocker to the markets. Chrissy talked about the 20% drop. And the expectation at that time on April 8th was that we'd have average tariffs in the range of 30%, which is higher than it's been for nearly a century. I think everybody knows that the current administration is using threats of tariffs as a very, very powerful tool and then backing them off. And so as of September 30th, the expectation is that tariffs will average more like 19%. That's a third lower. The first impact on tariffs is in gross domestic product, GDP. This is a complicated chart, but notice in the last 2 bars on the far right, what that's showing us is that there was a decline in GDP in the first quarter of this year. That decline was driven almost entirely by net exports. All of a sudden, the fear of tariffs caused American companies to buy both processed goods and final goods to stockpile them before the tariffs apply. And that caused GDP to record a 0.5% drop. In the second quarter, just the opposite occurred. Inventories, the dark blue line, declined as companies were basically spending down or using up the inventory that they had accumulated in the first quarter. And conversely, our net exports increased dramatically. So this is the near-term effect, volatility in gross domestic product. A secondary effect of tariffs is on inflation. This is a chart showing the components of inflation. You see the peak in inflation in June of 2022 was at 9.1%. Back in that post-pandemic era, energy consumption was quite high, and energy costs were a big part of the inflation, the high inflation in 2022, early 23. It's since come down dramatically. But if you notice, since the beginning of this year, the eight far bars on the right are indicating that inflation's ticking up marginally, and some of that is potentially due to the tariffs impacts. What's more interesting is that energy is no longer an inflationary factor. It's actually disinflationary. That's why the green bars are below the line. And we've seen basically housing inflation and the combination of food inflation. We've all been to the supermarket and seen ridiculous prices for eggs and other goods that we consume. And also importantly, dining, recreation, and other services. So we're seeing service inflation. That's the impact of the housing market is going to be important to bringing down this number to the Fed's target of 2%. Interestingly, we are seeing signs of disruption in demand. Not surprisingly, the shipping costs to move goods from China to the West Coast are coming down dramatically as our net imports from China are declining. Also interestingly is that lumber prices are down. After a very strong 22, 23, 24, we've seen much less demand, and that's because of housing. The housing market, we all remember a couple of years ago, there was extremely little supply with so many of us having sub 3% mortgages. The impetus to move and give up those mortgages when rates were rising was quite low. And so as a consequence, housing builders have taken out much fewer housing construction permits. So you see from a high of 1.9 million in 2022, they're down 50% to 1.3 million. And concurrently, mortgage rates have increased dramatically from where they were in the 3% range in 2021 up to a high of 8% in 2024. They're back down now, only at 6.36%. Expectations are that the interest rates, the 10-year Treasury rates will follow federal funds rates down, and so there'll be some improvement in the housing market potentially. So with that, I'm going to turn it over to Steve, who will talk about interest rates.
Great, thanks, Brooks. Yeah, we'll talk about interest rates, the U.S. dollar, budget deficits, and then we'll conclude. So this chart gives us a snapshot of where Treasury yields are for varying maturities of time. The data here is a comparison of three curves. The green line on the bottom shows us where interest rates were at the end of 2021. The blue line shows where rates were in September of 23, and then the gold line shows where rates are today. So the takeaway here is that interest rates have moved higher across the curve from where we were almost 4 years ago. And the reason for that is, as the Fed has said, to combat inflation, they have raised interest rates. But as rates have come down, we've seen over the last year or so, or as inflation has come down over the last year or so, short-term rates have also come down as the Fed has started to cut. The longer end of the curve, though, the 10, 15, 30-year treasuries have been relatively stable. There is some concern that due to our large budget deficits we're running, could push those rates higher in the future. The other thing that we look at here is the shape of the curves. So a steeper upward sloping yield curve suggests a growing economy, possibly higher inflation. An inverted curve can be an indicator of slower economic growth. And that's what we had back in 2022, 23, and early in 24. We had an inverted curve. And that's when the 2-year is yielding more than the 10-year. And remained inverted for almost 24 months, which at the time was a record. And at the time, if you recall, this was one of the reasons the market was so concerned about we were heading for recession, because this had been a pretty accurate recession indicator. But it looks like the streak of predicting recessions may be broken now as we've returned to a more normal curve. And at least for now, we've avoided a recession. So this next slide shows the history of the Fed funds rates going back to 1993, along with a path of rate projections by the Fed, and then also the market's expectations for future rates. So if we focus on the most current rate cycle that we've been in, the Fed started raising rates aggressively from 0 to 5.5% in 2022, and then began lowering rates at the end of 24. And then this year, because of the tariff announcements and the uncertainty around the impact of those tariffs, the Fed paused until they cut rates again last month. So the Fed will meet again next week. Next Wednesday, they'll make their announcement. The market is pricing in another rate cut of 1/4 point, and then possibly another rate cut in December. There is some speculation that we could get as many as 1 or 2 more rate cuts next year, but that will certainly be dependent on inflation and the jobs numbers that will be reported between now and then. So the U.S. has been running a budget deficit since 2001, but that deficit grew rather significantly during the financial crisis in 08 and 09, and then again during the pandemic. Now, historically, government has run deficits during periods of economic stress or recessions. And then typically when we come out of those recessions, the gap will close as the economy recovers, and the receipts, the tax receipts we receive, or the government receives, will increase. This period we're in now is a little bit unique because we're not in a recession, but the budget deficit is continuing to grow at a time when historically we would think it would be shrinking. So the current deficit we're running is approximately $1.8 trillion. The primary reason for the deficit is due to the mandatory spending on the entitlement programs like Social Security, Medicare. And it's a fact we have an aging population, so the demand for those benefits have been increasing. But it's also important to note what a challenge this is, because if we look at the nearly $7 trillion budget, about 86% of that budget could be considered mandatory spending. So if you include Social Security, Medicare, but then also include defense and interest expense, so that's the interest payments we're making on our U.S. debt, which is not negotiable. If you take those 4 categories, again, they make up 86% of the budget. So there's no politician's going to be advocating to reducing any of those 4 areas. So it leaves very little room for budget cuts. And if cuts are going to be made, then it's education, infrastructure, fixing bridges and roads. So it is a challenging problem, but something that needs to be addressed here in the near future. So another fallout of the U.S. debt concerns is a weaker U.S. dollar. So this dollar index goes back to 2004. You can see it's been volatile. The dollar's been volatile over time. There is concern that the dollar may be losing its status as the world's reserve currency. There are efforts by countries, nations to de-dollarize. They've been increasing trade in their own local currencies or developing alternative payment systems. And this is also a reason why the price of gold has gone up because of what's going on by certain central banks and countries. However, the data shows that the majority of trade around the world is still done in dollars, and the dollar's resilience stems from our unmatched liquidity here in our U.S. financial markets. And there really is no alternative. If you look at either the euro, the Chinese renminbi, they just don't have the liquidity or the stability of the US dollar. So yes, you could argue that as the global financial landscape is evolving, there are countries, central banks moving away from the dollar, but the dollar dominance will continue, and we don't see that changing in the next months or years. It could be decades before that actually occurs. And then prior to the financial crisis in 2008, the Federal Reserve's balance sheet was less than $1 trillion. During the financial crisis, the Fed instituted quantitative easing to help shore up our banking system and took their balance sheet from 1 to about 2.5 trillion, and then it ballooned to 4 trillion. In 2018, the Fed announced it would start reducing its balance sheet, but then the pandemic hit and the balance sheet expanded to $9 trillion. As the Fed was injecting liquidity into the markets. In 2022, the Fed began quantitative tightening, which meant they were allowing treasuries and mortgage securities to mature and roll off the balance sheet. So far, they've successfully reduced the balance sheet by nearly $2.5 trillion without causing any liquidity problems in the market. And this overall is good news. It is taking money out of the system, but it also leaves room for expansion if we experience another financial crisis. So with that, I'll hand it back to Chrissy, who will conclude our presentation.
Thank you so much, Steve. All right, so I know we've gone over a lot of information today, so I'll just highlight some key takeaways and conclusions that we can draw from all of this information. So first off, corporate earnings growth has been strong. Margins continue to trend upward. We are seeing that trend continue in the most recent earnings season as well. Consumer spending is really resilient. It's been driven by top earners. So even as those lower income earners are feeling pinched, that top 10% of earners is still representing nearly half of all consumer spending. And so that's helping prop up consumer spending. AI spending and Optimism have supported markets. They've boosted equities to near all-time highs, but this has caused valuations to also creep back up to the highs seen in 2021. And while inflation is still running above the Fed's 2% target, we could see delayed impacts from tariffs push it even higher. We're also continuing to see signs of slowing job growth. And while we aren't receiving official non-farm payroll numbers amidst the government shutdown, several other alternative data sources are also demonstrating that slowdown. Despite this, as Steve mentioned, the Federal Reserve does have tools that it can use if conditions worsen. So the Fed has already begun its cutting cycle, and they have more room to cut interest rates if needed. They also have made significant progress reducing that balance sheet, opening up the opportunity for them to pivot and expand their balance sheet in a crisis. So with that, we will move on to the Q&A portion of our presentation. Again, if you have any questions, please click on the Q&A button on your meeting controls at the bottom of your screen to ask questions. So first question we have here is, how much reshoring has actually occurred this year?
I can take this one. I think this is going back to Chrissy commenting on the sector returns. One of the standout sectors this year, aside from communication services and technology, is the industrial sector, and the reshoring was one of the drivers behind. I think there's a couple of drivers, but to answer that question, I would probably speculate that not a lot. I think that the announcements have been made. I think realistically, reshoring will take many years, a lot of planning, a lot of investment. And I think we are in the announcement stage of the reshoring. So, you know, Apple announcing a $500 billion investment in the US, Intel announcing that they're bringing jobs back to the US, Micron opening some factories in the US. Those are announcements, and I think a lot of these companies have realized they get political credit for those announcements, even if it takes time for those plans to actually go through. And even if ultimately the plans never go through, they may say, well, you know, we had plans to do it. So I think that's probably the phase we are in. That's actually still been a bit of a catalyst for these industrial companies, kind of because of the sheer fact of kind of the buy the rumor, sell the news sort of a thing. So an announcement of a $500 billion investment is going to have a positive impact on, say, Caterpillar, which is, you know, heavily invested in or heavily levered to the, you know, construction of a data center, for example. So that's an example. That's one of the largest parts of the industrial sector, one of the largest companies in the sector. It's performed well, even if that ultimate revenue is sort of down the road. Just that's kind of how these markets work. They pop on the initial announcement, even if it's not durable. Anyone else can jump in and add if there's anything else to say there.
I think you covered it. So next question I have here is, are we in an AI bubble?
I can take this one. I think a couple months ago, Sam Altman, the CEO of OpenAI, came out and said we may be in an AI bubble, and he probably has a pretty good pulse on the industry. You know, I think looking at it, you've got just the massive amount of dollars being invested in the AI infrastructure build out is a little concerning. When you're talking $2 to $3 trillion over the years, that's going to be close to 7 to 10% of our country's GDP. For historical reference, the dot-com bubble was about 5% of GDP. The railroad bubble in the UK was, I think, closer to 10. So we're well within that range of this could be an overinvestment in, you know, excitement over new technology. Whether this will turn out to be a boom or a bubble is really going to be dependent on the revenue generation from this technology. And, you know, currently OpenAI, I believe, has around $13 billion in revenue. They're not profitable, but they will generate $13 billion in revenue this year. And that's just from subscriptions. So, you know, on the near-term horizon, there could be advertising, there could be wearables, and it could get integrated into robotics. And when you start getting into some of those industries, I think that's where the big revenue opportunity is. It's just too early to tell.
Great, thank you, Evan. Our next question here is about gold. So why is gold up so much this year?
I'll take that one. Yeah, great question. And it's not just this year. Gold has been on a fantastic run over the last 3 years. And you know, historically, the reasons investors own gold was as a hedge against inflation. It was also seen as a safe haven asset. The challenge with owning gold is, one, is where to store it, and then two is just how do you value it? How do you determine its intrinsic net worth? Warren Buffett has famously said he doesn't own gold because it doesn't pay a dividend. But what we've seen recently is it's a gold debasement trade going on that's pushed gold to an all-time high, trading over $4,000 an ounce. And it's being driven by primarily China and other central banks around the world that are fearful that they have too much exposure to the US dollar. So if a conflict breaks out, their assets could be frozen, similar to the sanctions imposed on Russia after its invasion of Ukraine. So China has been exchanging dollars for gold I think they've concluded that they would rather own the physical gold and keep it within their borders as opposed to holding the dollar and having the U.S. To freeze that asset if a conflict broke out. So yeah, we continue to recommend holding gold or gold miners. It's again a difficult asset to value, but we think it's a prudent holding in a diversified portfolio.
Thank you, Steve. Here we have a question about international or emerging markets.
I'll take that one. We have a higher level of exposure to international today than we've had in 20 years. That's contrary to most investment advisors who buy the Ingrid Bergman paper that was written in 1992 that basically said what they advocated is we should be market cap weighted to the world capitalization in international. That would demand a 40% allocation to international. And yet in the time since 1992 to today, more than 2/3 of the time, the US markets have outperformed and have outperformed by a factor of fivefold. So you may, if you saw our last presentation, you may have seen the chart that showed US markets relative price earnings multiples to international market price earnings multiples, where we're at 2 standard deviations above the average. About 6 months ago, international developed markets were 2 standard deviations below the average. And so we just thought, okay, on a valuation basis, this has gotten very, very cheap, and we need to increase market exposure. We're about half of the world capitalization. I think that developed markets have challenges. I mean, if you think about it, excluding China, which is purportedly an emerging market still, the international markets in Europe have lots and lots of problems across the Euro community. Emerging markets had a very strong third quarter, but they have been weak for quite a while. The higher rates that we've seen, not only have emerging markets been weak, but so has U.S. small cap been weak. And that's probably due largely to the higher rates, which impact emerging markets and small companies in the U.S. We think that it's still time to continue the relatively higher weightings. The valuations are still more compelling internationally than in the U.S.
Well, if there aren't any other questions, we can go ahead and conclude for today. So I'd like to thank everyone for coming out to our annual presentation, and we look forward to talking with you all soon.